What if I told you that the most important development in the silver market right now is not being talked about on CNBC, Bloomberg, or anywhere else the average investor tends to look? While attention remains locked on gold, something far more significant is quietly taking shape out of view. Central banks are no longer merely observing silver. They are steadily and silently accumulating it at levels not witnessed in nearly 40 years. As of January 8, 2026, silver is trading near $75 per ounce. 1 year ago, it was priced below $30. That represents a 158% increase in just 12 months, the strongest annual performance since the late 1970s. And yet, despite what headlines may imply, this is not the end of the move. It is not even the peak. This is the opening scene of the most explosive phase of the cycle. People like to dismiss large price targets as speculation because it makes them feel intelligent. But when I say that $150 silver is not optimistic but inevitable, I'm not guessing. I am identifying a pattern that has repeated without exception for more than a century and a half. The same setup, the same mechanics, the same result. Different decades, different players, but the same conclusion. And right now, that pattern is flashing like a fire alarm. There is a 4-stage cycle embedded in monetary history. This is not theory or opinion. It is a recurring process that appears whenever governments stretch money too far for too long. Once you understand it, you stop reacting emotionally to price movements and begin to see where the chessboard is heading next. The first stage is always calm, even dull. Governments construct systems anchored to precious metals. Gold holds the throne. Silver plays a secondary role. It circulates, it functions as money, but it is not celebrated. Industrial demand is limited. Technology remains primitive, and everything feels stable enough that no one asks uncomfortable questions. This is the moment in the movie where the audience relaxes, unaware that the floor beneath them is already beginning to creak. Then the second stage arrives, and it always begins quietly. Governments realize they can promise more than their metal reserves can support. Credit expands. Spending accelerates. The money supply grows faster than any tangible backing. Gold largely holds firm because it is protected, hoarded, and revered. Silver does not receive the same treatment. It begins to lag. The gold-to-silver ratio stretches from historical balance into uncomfortable territory. 20-1, 30-1, 50-1, sometimes worse. Nobody panics because asset prices are still rising and confidence has not yet broken. Silver simply looks cheap, forgotten, and slightly embarrassing, like a relic valued by grandparents. Stage 3 is where denial ends. Inflation arrives uninvited. Confidence in currency begins to wobble. Banks fail, credit freezes, and people suddenly realize that paper promises may not be worth what they assumed. Governments panic. But here's the part most people miss. Gold alone cannot solve the problem. It is too scarce and too expensive. There's not enough of it to rebuild a broken system at scale. They need volume. They need something with monetary history, public trust, and real supply. They need silver. But they cannot say that openly without igniting a fuse. So they accumulate it quietly through proxies, industrial mandates, strategic reserves, and mechanisms designed specifically to avoid headlines. Then comes stage 4, the snap. This is the moment when the stretched rubber band does not slowly drift back but violently recoils. The gold-to-silver ratio does not gently normalize. It collapses. Silver does not grind higher. It explodes. These moves do not take decades. They unfold in months, and the wealth transfer is brutal. Those positioned early watch their purchasing power surge. Everyone else chases prices that already left the station. We have seen this exact movie before. 3 times in modern history, the same sequence played out with unsettling precision. In the late 19th century, silver was officially demoted. Germany adopted gold exclusively. The United States followed. Silver lost its monetary role almost overnight. Prices collapsed. Mining towns died. Entire regional economies vanished. The gold-to-silver ratio doubled. Silver was declared obsolete. Then the 1890s arrived. Depression, bank failures, and currency shortages followed. Governments realized they had removed too much metal from the system. Gold could not carry the burden alone. Silver was quietly reintroduced through legislation and strategic purchases. Prices did not merely recover, they multiplied. Those who accumulated during the crisis built generational wealth. Those who waited paid retail. Fast forward to the 1970s. Same structure, different decade. Silver was removed from coinage. Spending surged. Wars, social programs, and deficits exploded. Inflation followed. The gold window closed. Confidence fractured. Once again, quietly, silver flowed into strategic stockpiles under the banner of national security. When the snap occurred, it was violent. Silver moved from single digits to $50 in less than 2 years. The ratio collapsed. Fortunes were made and destroyed almost overnight. The public was given a villain in the Hunt brothers. The deeper story remained buried. Then came 2008, credit excess. Financial engineering run amok, leverage stacked upon leverage. When it broke, It broke brutally. Trillions were printed. Faith in fiat cracked again. Gold ran first, silver lagged, and once more behind the scenes, accumulation resumed through indirect channels. By 2011, silver surged more than 400% in under 3 years. Same pattern, same result. What followed confused many. Silver did not settle into a new stable system. It was suppressed. Paper markets took control. Physical prices and quoted prices drifted apart. For more than a decade, silver went nowhere. Boring, range-bound, written off, exactly like every Stage 2 lull throughout history. What people missed was this. The pressure never disappeared. It compounded. Debt expanded. Monetary discipline vanished. Supply constraints tightened. Industrial demand surged. The spring did not relax. It coiled tighter. And now, in 2026, we are watching it release. Silver did not rise from $29 to $75 by accident. Central banks did not suddenly rediscover interest for nostalgic reasons. This is Stage 4 forming in real time. Not announced, not celebrated, simply executed. The uncomfortable truth is this: by the time silver feels safe to buy, the opportunity is gone. That is always how this ends. Stage 4 does not reward late confidence, it rewards early discomfort. History does not repeat because people are foolish. It repeats because incentives do not change. And right now, every incentive is screaming the same message it has before every major silver revaluation. Most people will learn about this when it is already obvious, when the price has doubled again, when headlines finally pay attention, when neighbors start asking questions. And by then, the math is no longer in their favor. This is not hype. It is not fear. It is recognition. And once you see the pattern, you do not argue with it. You respect it. For a time, everything appeared calm again, or at least calm enough to convince people to stop asking questions. Markets stabilized. Confidence returned, or more accurately, the appearance of confidence returned. Silver faded into the background, where it is most dangerous to ignore. Mining companies quietly collapsed. Exploration budgets were slashed. Primary silver mines shut down. Junior miners could not raise capital. The sector did not just cool off, it flatlined. And that was not accidental. That was Stage 1 doing exactly what it always does: clearing the field, killing interest, and laying the groundwork for the next cycle while nobody is watching. Then March 2020 arrived and tore the mask off. COVID hit, followed by the most aggressive monetary response in human history. The Federal Reserve created $5 trillion in roughly 18 months. $5 trillion. The M2 money supply expanded by about 40%. Government debt jumped from $23 trillion to $36 trillion in 4 years, a 57% increase that would have been unthinkable in any previous era. But we were told not to worry. Inflation was transitory. Jerome Powell said it. Janet Yellen said it. Every television economist nodded along like dashboard bobbleheads. It was transitory until it was not. Official inflation reached 9%. Real inflation, measured the old way before the numbers were gently adjusted, was closer to 15%. Real wages collapsed. Purchasing power evaporated in plain sight. Food, rent, energy, everything cost more. And yet, silver barely moved. Why? Because paper markets kept a lid on it, and people still trusted the system enough to believe normalization was coming. That was Stage 2 in its purest form: open debasement while the most undervalued monetary metal remained artificially cheap. Now we are in Stage 3, and unlike earlier phases, this one does not whisper. It leaks through every crack. Banks began failing in 2023. Silicon Valley Bank, Signature Bank, First Republic. These were not small institutions. They held hundreds of billions in assets. Credit Suisse, one of the oldest banks in the world, did not survive without forced rescue. The Deutsche Bank continues wobbling like a shopping cart with a broken wheel. Regional bank stocks are down 40% to 60% from their peaks. Commercial real estate is collapsing. Office buildings in major cities trade at half their value from 2 years ago. And then there is the treasury market, supposedly the safest market on earth. In 2022, it suffered its worst year in 240 years. 240? That is not a typo. That is a historical anomaly large enough to unsettle anyone capable of pattern recognition. But here is the number that truly matters. Now look where the cameras are not pointed, because this is where the pattern becomes undeniable. In 2023, the Shanghai Cooperation Organization, including China, Russia, India, Pakistan, and several Central Asian states, announced strategic metal reserve initiatives. No detailed breakdowns, no press-friendly explanations, just quiet acknowledgement. Around the same time, China's silver imports reached a 10-year high and remained elevated through 2024. India, the world's largest silver consumer, increased imports by 57% in the first half of 2024, driven not by jewelry demand but by investment and strategic accumulation. Russia went further, openly stating that BRICS plus trade settlement would be backed by precious metals, explicitly naming silver alongside gold. Russia is the sixth largest silver producer on Earth. They do not casually mention silver without monetary necessity. Then Mexico, the world's largest silver producer, passed legislation in 2024 restricting exports until domestic strategic reserves are fulfilled. Let that sink in. The largest producer is keeping its silver at home. This is not coordination, it is convergence. Different governments, systems, and agendas independently reaching the same conclusion. Silver is strategically critical, monetarily necessary, and scarce. And they are accumulating it quietly because once stage 4 becomes obvious, it is already too late. Now let's look at the math, because this is where inevitability replaces opinion. Global silver mine production is approximately 830 million ounces per year. That is total output from every mine worldwide. Industrial demand alone consumes roughly 570 million ounces annually. That leaves about 260 million ounces for investment, monetary demand, and reserves. That is not much. If just 3 major central banks decided to acquire 100 million ounces each, that is 300 million ounces of demand, 40 million more than the entire available supply. The numbers do not balance. The market cannot clear at current prices. And we are already running deficits. The Silver Institute projects a 142 million ounce supply deficit for 2024, marking the 4th consecutive year where demand exceeded supply. 4 years in a row. Yet prices remained muted, until recently because paper contracts do not require physical delivery. But paper promises always collide with physical limits eventually. COMEX registered silver inventories have dropped from roughly 400 million ounces in 2021 to about 270 million ounces today, a decline of 32%. Meanwhile, vaulted silver at the London Bullion Market Association collapsed from approximately 1.1 billion ounces in 2021 to near 300 million ounces by the end of 2024. More than 700 million ounces disappeared in just 3 years. It did not vanish, it moved east. It entered strategic hands. It went exactly where silver always goes during stage 3. And industrial demand only amplifies how explosive this becomes. Silver has the highest electrical conductivity of any metal on Earth. There is no substitute. Solar panels, electric vehicles, 5G infrastructure, and military systems all require silver. Each solar panel uses roughly 20 grams. Installation rates are accelerating worldwide. China alone installs more solar capacity every quarter than the entire United States installed in all of 2020. By 2030, green energy alone is projected to consume an additional 200 million ounces of silver per year. That absorbs most of the remaining investable supply permanently, locked into infrastructure. Then comes psychology, which is where this turns violent. When confidence breaks, capital rushes toward tangible assets. Gold moves first, it always does. But at $6,600 per ounce, gold is inaccessible for most people. Silver at $75 is not. Gold is the asset of institutions and the wealthy. Silver is the asset of the masses. And there are far more masses than institutions. Here is the thought experiment few are willing to confront. If just 1% of global financial assets attempted to move into physical silver, that would represent roughly 18 trillion. The entire global silver market, at current prices, is worth around $63 billion. That equates to $28 chasing every $1 worth of silver. In that scenario, prices do not grind higher, they gap. Exchanges halt, premiums explode, physical metal disappears. We received a preview of this in March 2020. Paper silver collapsed to $12. Physical silver could not be purchased below $22. Premiums surged past 80%. Dealers ran out of inventory. Mints halted sales. Delivery times stretched from days into months, and that was merely retail panic. Stage 4 involves sovereign competition. Every objection assumes the current system continues to function. That is the error. The system is breaking now. Silver cannot be printed. It cannot be digitally created. At some point, delivery matters. And when it does, mathematics wins, physics wins, and paper loses. That is why stage 3 feels uncomfortable. That is why stage 4 feels sudden. And that is why, historically, it always catches most people completely unprepared. At this stage, whether people accept it or not is almost irrelevant. The crisis phase is already underway, and stage 4 does not wait for consensus. It never has. The real question is not what is coming. The real question is what you do before it arrives. Because positioning late is effectively the same as not positioning at all. The first thing to understand is that this is not about swinging for home runs or bragging about perfect entries online. This is about preservation first and upside second. Anyone attempting to buy the exact bottom or sell the exact top is playing a game designed to punish them. That is how retail capital gets churned. The winners in every cycle are far less exciting. They accumulate during stage 3. They hold through the chaos of stage 4. And they allow mathematics to do the work. Volatility does not scare them because they expected it. Start with physical silver, not ETFs, not futures. not clever structures that appear efficient until they are not. Physical metal that you actually control. Coins, bars, rounds, whatever format you prefer. The format is not the point. Ownership is. When stage 4 arrives, counterparty risk stops being theoretical and becomes existential. An ETF is a promise. A futures contract is a legal agreement that can be cash settled when delivery becomes inconvenient. Physical silver is silver. Period. The small premium people worry about today becomes irrelevant when the metal is repriced dramatically higher. Obsessing over saving 3% on premiums while ignoring the potential for a 100% move is focusing on pennies while a freight train approaches. Once physical is secured, and only then, leverage makes sense. That is where mining stocks enter. High-quality miners can offer 3-to-1, 5-to-1, or greater leverage to silver's upside. A 10% move in silver can translate into 30% or 50% gains in the right equities. But miners are not silver, they are businesses. And businesses carry risks. Political risk, permitting risk, management errors, cost overruns, labor issues, geological surprises, equipment failures. Even during powerful bull markets, miners can disappoint. That is why physical comes first. Mining exposure is an amplifier, not a foundation. The next critical component is understanding timing and managing psychology, which is more difficult than any chart analysis. Stage 4 moves are fast, violent, and emotionally draining, but they are always preceded by long, frustrating stretches of stage 3 grind. That is where we are now. Silver rising from $29 to $75 in a year feels massive, and it is, but it is not the final act. Stage 4 is when $75 becomes $150 in a matter of months, when silver gaps $10 in a single session, when premiums explode and availability evaporates. The accumulation phase never feels exciting. It feels irritating. It feels like you are early. That is not a flaw. That is the design. The crowd always arrives late. They show up after silver has already doubled, after it has held above a major psychological level long enough to feel safe, when mainstream media begins explaining why silver finally makes sense, when relatives who have not asked about markets in a decade suddenly want opinions. By then, the easy gains are gone. You want exposure at $30? You want to be adding at $50? You want to already be positioned at $75, not negotiating with yourself emotionally at $120. There will be noise, a lot of it, false breakouts, sharp pullbacks designed to shake people out, confident articles declaring silver is about to collapse for the 5th time this year, analysts calling tops because it feels courageous. None of that alters the underlying reality. Supply deficits do not care about sentiment. Industrial demand does not consult technical indicators. Central banks do not reverse accumulation because of a bearish headline. The forces driving stage 4 are structural, not emotional. Preparation also means understanding how ugly stage 4 becomes in practice. When the pivot happens, it is not just prices moving on a screen. Premiums surge, dealers run out of inventory, mince ration production. Delivery times extend from weeks into months. Purchase limits appear overnight. This is not theory. We saw it in March 2020 on a smaller scale. We saw it in 1980 on a much larger one. When everyone wants silver at the same time and supply is insufficient, price almost becomes irrelevant because availability vanishes. Positioning now during stage 3 is about securing access before access itself becomes the scarce asset. Zooming out, this is not only about silver, it is about systems and how they fail. It is about recognizing patterns history has documented repeatedly. The idea of $150 silver is not a bold forecast. It is a consequence of debt levels that cannot be serviced honestly, a consequence of currencies dependent entirely on confidence, a consequence of industrial demand colliding with geological limits, a consequence of a gold to silver ratio stretched beyond every historical extreme. Central banks are not accumulating silver because it is a fashionable trade. They are doing so because they understand something most people do not. Gold alone does not stabilize a collapsing system. It is too scarce and too concentrated. You need monetary mass. You need volume. You need something that exists in sufficient quantity to matter, but not so much that it loses value. Silver occupies that narrow window. That is why it re-enters the system at the same point in every cycle. And that is why accumulation is happening quietly now, before competition becomes visible. They do not want to bid against the herd. They want to be finished before the herd realizes the barn is burning. The pattern does not care about timelines, narratives, or press releases. When physical supply drops below critical thresholds, paper markets lose control. Price discovery migrates from futures exchanges to physical markets. And when the gold to silver ratio snaps back, it does so violently, often shocking even those who anticipated it. Every indicator aligns exactly as it did before previous pivots. Strategic announcements from global blocks, silver imports surging across Asia, vault inventories draining, futures inventories declining, multiple consecutive years of supply deficits. None of this is random. The only remaining variable is timing, and history is clear on one point. The transition from late stage 3 into early stage 4 happens faster than anyone expects. It is not smooth, it is not gradual. It is a phase shift. One day things feel manageable. The next, markets reprice in real time. 1 month silver trades at $75. The next, it trades at $120. 1 week physical is available with reasonable premiums. The next, dealers are sold out and shrugging. The people who understand this are not waiting for confirmation. They are not waiting for media approval. They are not waiting for perfect pullbacks. They are positioning now. Physical first, select miners second. Psychological preparation always. Those who do not recognize the pattern will do what they always do. They will debate soft landings. They will wait for one more dip. They will convince themselves this time is different. And then they will chase prices that already reflect the opportunity they missed. They will not lose because they were wrong. They will lose because they were late. This is the most important positioning window most people will encounter in their investing lifetime. Stage 4 events do not happen annually or even once per decade. They occur once per generation. And when they arrive, wealth creation and destruction compress into months, not decades. The dates change. The structure does not. Late 19th century, late 1970s, post-2008, and now mid-decade again. The cycle is completing. The math is unavoidable. The pressure is visible. If this analysis resonates, if the pattern feels uncomfortably clear, then you already know what needs to be done. Position now, not after the next pullback, not after another headline. Now, while silver remains obtainable, while premiums remain rational, while stage 3 is still unfolding, and stage 4 has not fully ignited. And if this helped reframe how you see the market, stay connected. What we covered here is only the framework. There are deeper mechanics, specific opportunities, and timing signals that matter when volatility accelerates. In the next breakdown, the focus will be on silver miners' position to benefit disproportionately when silver pushes into triple digits. Companies most analysts are ignoring, trading at valuations unlikely to exist a year from now. The pattern has never failed, not once. Participation is optional. The cycle is not. Most will do nothing. Some will hesitate until it is obvious. A few will act early and let history repeat in their favor. Choose carefully. Stage 3 is ending. Stage 4 is approaching. And silver at 75 is not an argument.